Dear investor, in this edition, let us discuss the following. 1. Market outlook after the election process has ended, our portfolio positioning for the same, inclusion in JP Morgan Bond Indices, themes whether they would change after elections or remain the same, and ultimately valuation and upsides. Point number 1, election process has ended. The end of the election process to elect the new government is close, and the result would be in on 4th of June. Once the uncertainties are behind us, focus would come back on fundamentals. Now, we note that India has seen a sustained bout of FPI selling, and one reason could be election uncertainties, while the other seem to be rebound in Chinese equities after a sustained slump. Chinese indices are up between 19 and 25% over the past 3 months. China has a larger weight than India in the indices, and when that market performs, it pulls in money. Continuous FPI selling in domestic market would continue till outperformance is there. Once it stops, it would cause rebalancing. Today, India presents a compelling story. It is the highest ROE market in the region and is the fastest growing large economy. While growth has been happening, leverage of corporate India has come down as a percentage of GDP and banks are in good health. With capacity utilizations now getting better, we are on the cusp of a good private sector led capex, especially in an environment where policymakers can provide a degree of protection on reverse globalization. Global investors, we believe, look at emerging markets for growth, and today India offers a very compelling multi-year growth story. A good possibility is that rebalancing of global portfolios coincide with the election outcomes and or budget outcomes. In the event of the election and budgetary outcomes being to the market liking, there is a possibility that we see spike in FPI inflows as the current uncertainty reduces, or at least there is a halt to continuous selling that we are witnessing. Something similar happened after the state election results, which also kind of coincided with 10-year US yield dropping. Domestic flows continue to remain strong and unabated. If the FPI selling stops, we think there is a possibility of Indian markets correcting the underperformance of the past 3 months versus global peers post elections and maybe post budget if the outcomes are favorable. This we believe is a high probability event. However, as a caution, reverse could be true as well. How are our portfolios positioned for the post-election scenario? Once again, our thoughts are that FPIs are growth-focused investors. In the past, IT and banks used to be the growth leaders in the country, and close to 50% of FPI money is invested in these spaces. These are large and liquid spaces also. However, these spaces are no longer the growth drivers of earnings. The earning growth outlook for large cap IT companies over the next several years is significantly lower than that of the index. Outlook for bank earnings is also converging with index earnings growth in the near term. In December 23, however, we note that these spaces still saw a strong up move when FPIs last came in strongly. Since we are underweight these spaces, this is a risk. However, we also note that the up move did not sustain. This points to a possibility that what we saw could have been a bout of short covering. We believe that while the possibility of strong performance of these spaces in the event of strong FPI inflows remain, it is lower than before, given that the growth leadership has passed on to other areas. In any case, over time, the flow of money would find its way into the growth spaces of the economy. We hence believe that we are well positioned, say for that first period. We are running some of the fastest growth in EPS portfolios to our mind, and with a large earning growth delta over the index, with a focus on good quality of business and management. And these businesses are well positioned in the growth themes of the country, which should sustain given the needs of the country itself. Domestic investors like these spaces, and chances are that FPI would also like. The same spaces benefit from any reduction in interest rates as cost of capital also reduces. On the next point, inclusion into the JPM Bond Indices from June 24. This has been a much awaited event and would start from June. We expect incremental demand of around $2 billion per month for government paper, and the yield on government paper should reduce as a consequence. Marginally, that will provide some support. This should also reduce refinance cost for the government. Also, if the yields on government paper reduces, the ability of corporate India to access the domestic savings pool would improve. This again helps the capex theme. Now, coming down to the next topic, which is, would growth themes change post-elections? So that is a thought. Every intervention can result in changes. Let us address this in the following manner. One, some themes are global in nature, and every government would focus here. There are global pushes and pressures towards them. They are, for example, defense. Globally, expenditure as a percentage of GDP on defense is rising after Russia, Ukraine, and Israel Hamas. This is expected to continue. The names we are exposed to are PSU names in the theme, and our platform companies very well positioned. They should continue to do well irrespective of election outcomes. Second global theme is renewable. With global warming, generating energy from renewable sources has been the focus across the world. India has 2 wind power generating companies, domestic companies, and a few solar names could emerge. This theme should hence also continue. Make in India, or should I say China plus one, these includes chemicals, EMS, garmenting, etc. And government policy is to give sops to corporate India to set up manufacturing base here. This is not unique to India. Many other countries are doing the same, including the US, for spaces that they deem are important to them. With China plus one sentiment ruling, strongly, this theme should also continue. Maybe since this involves government support to some extent, the winners of this theme could change in the event of a new face emerging as a PM. So this is to keep in mind. Wherever the nearness to the government is of an higher order, while the theme could remain the same, the winners could change. Next is to look at Indian themes, which are a result of long period evolution of the country. For example, luxury consumption. So we as a house are invested in premium housing, jewelers, food delivery companies, etc. The outlook for none of these change with election outcomes. These are dependent on the growing per capita incomes of our population, which is a very, very long-term trend. So I think this continues. Similarly, banks, NBFCs, capital market as a theme. Banks and NBFCs are in good health and have seen repayment of loans. They should also not be hence impacted much, at least in the immediate term, on any government change. Where the face of the government changes, however, capital market companies may have to tackle lower volumes, so for exchanges and for brokers, as people adjust to new realities and prices, if the growth outlook with the new dispensation changes for the lower, and policy uncertainty. So this may impact capital market related businesses. So this is a space where as a house we are exposed to, which could look at that vulnerable in case of a regime change. Like we said before, this seems to be a low probability event. Hospitals once again is a low impact space because it's the need of the hour, and need for more of them is very palpable. In short, except for close to government spaces such as construction, we don't have any exposure here. Market volume and level driven businesses such as brokerages and exchanges, I think we see continuity post elections and believe that we are well positioned. The reform process would move forward and get deeper is our thought, and we are trying to increase the weight of businesses that would benefit from the same. Valuations and upside, the last bit. Now, markets have consolidated for a quarter now. A 3-month consolidation corrects valuations by between 4, 5 and 6% for large, mid and small cap spaces respectively, given the strong earnings growth momentum. Markets are today valued in line with historical trends for the large caps, but here the earnings growth outlook is better. Quality of business is also better with improvement in return ratios. We have seen margins improve a tad as we have gone forward. These are two parameters that are input for valuations, and both are looking better. Reverse globalization and positive policy making environment is helping India Inc. We had noted in our previous editions that with better growth in earnings outlook, better governance and prospects of interest rate cycle changing direction, towards being lower, current period could see sustained better than average valuations. In the process, maybe pulling up long period averages also, particularly if the policy momentum continues to be supportive. This is already true to some extent for the mid and small cap part of the market. We note that 1% higher growth in earnings sustained for 10 years improves the valuation outlook by close to 5%. Overall, we believe the markets are at sustainable valuations and could provide better than earnings growth related returns as the cost of capital reduces. Cost of capital reduction should increase the competitiveness of growth businesses over value part of the market, and should provide our portfolios with further tailwinds. Thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.